Man, the markets, huh? Just a little while back, it felt like all we heard about were record highs. And now, we're in a correction. A pretty significant one, too.
It does feel like a bit of whiplash, doesn't it?
It really does. The Nasdaq, for instance, it's taken a real hit, down over 21% from that peak we were all watching. Officially, that puts it in bear market territory.
Yeah, a bear market for sure. And the S&P 500, well, that's not exactly a picnic over there either.
Not at all. Down about 17.5%, at least as of last Friday's close. I've even heard some folks calling this a tariff-induced tumble. Kind of catchy, don't you think?
It has a ring to it, yeah.
Yeah.
But for our listeners out there, those who are thinking long-term, like we always encourage, well, these kinds of dips, they can be pretty darn interesting.
Exactly. Interesting in the sense that they might, just might, open up some real opportunities. So that's what we're diving into today. We're going to navigate this downturn and see if we can't spot some compelling investment ideas that might be emerging.
We're going to focus on a couple of companies in particular, companies that have definitely felt this market shift, seen some pretty noticeable drops from their all-time highs.
Two big names, actually. First up, we've got Alphabet, ticker symbol GOG, down a hefty 29% from its peak. And then we'll move on to Airbnb, ABNB, which has seen an even steeper drop, a full 51%. Oof. So first things first, let's talk Alphabet. It's been, let's just say, a little rough for anyone holding that stock lately, wouldn't you say?
Yeah, it's definitely been a bit of a roller coaster ride for those shareholders.
Yeah.
That 29% drop you mentioned, that's a pretty substantial drawdown. And when we dug into the research, a couple of key factors really jumped out. They're kind of interconnected, too. The first is what some are calling, and this goes back to that catchy phrase, the tariff tantrum. Basically, it's this overall anxiety in the market about tariffs and what they might do to the economy.
Yeah, that makes sense. Tariffs get slapped on, prices go up, people maybe buy less stuff. It's that whole idea of tariffs potentially putting the brakes on economic growth. And then the second factor you mentioned, that's the whole AI thing, right? All this new competition popping up in the artificial intelligence space. And some see that as like a direct challenge to Google's long-held dominance in search.
Exactly. I mean, Google search has been the king for so long, right?
Yeah.
So for investors, it's natural to be a little uneasy when something like this comes along.
And you can almost see the line of thinking. If these tariff fears actually become reality, if we see a real economic slowdown, then a company like Alphabet, a company so heavily reliant on advertising revenue, well, it could take a hit. Their growth might slow down. So it's tempting to just look at those immediate worries and call it a day, right?
It is. But what I find so fascinating about Alphabet, what we always try to do here on the deep dive, is to look beyond those headlines, those immediate anxieties. Because when you step back and really look at the big picture, Alphabet has built up this incredible foundation of strength, this just sheer dominance across so many essential parts of the tech world.
You're right. Sometimes it's almost too easy to forget just how much they've got their fingers in, how long they've been leading the pack.
Yeah, exactly. We're talking Google Search, still the undisputed champion.
Yeah.
YouTube, the global go-to for video content. And then there's Android powering, like the vast majority of smartphones out there. And then even in the cloud computing space, Google Cloud is making some serious moves, becoming a major player.
In all of those aren't just little side projects. These are massive, established parts of their business.
Right, pillars of their business.
But one of the things that really stuck out to me in the research for this episode is that they're not just sitting back, relaxing, and enjoying the view from the top. They are still pouring money, investing heavily in tech advancements, particularly in AI, in all these new and innovative AI tools. And on top of that, they even have their own hardware edge with their Tensor processing computer chips.
Oh, yeah, they are not standing still. That's a crucial point for investors to consider. And, that, to me, suggests that this is a company actively pushing to not just stay where they are, but to actually expand their lead. What do you think?
I think you're right on the money. It brings us to this whole question of how we should be viewing the AI competition, because the knee-jerk reaction might be to just see it as a threat, right? Like, oh no, here comes AI, it's going to eat away at Google's search market share. But the argument our sources are making is that we should really be looking at AI as an opportunity for Alphabet, a big one, because they have the resources, the talent, the global infrastructure, all the ingredients to be a real leader in this space.
Yeah, they're uniquely positioned, that's for sure. And you can already see it happening. They're weaving their innovative AI capabilities across their entire product line, everything they offer.
So let's switch gears a bit. Let's move away from the market anxieties and talk about the potential upside for investors. For those considering buying into Alphabet, The article we looked at, it highlights that Alphabet stock is currently trading at a price-to-earnings ratio, a PE, of around 18, and it uses the word cheap to describe that.
Yeah, cheap in the sense that for a company like Alphabet, with its market presence and its future potential, that PE ratio does look pretty darn attractive.
It really does. And when you consider that valuation alongside the revenue growth they've been demonstrating, well, it becomes even more intriguing.
Oh, absolutely. In 2024, Alphabet saw a 15% year-over-year increase in revenue. And that's even after you factor in currency fluctuations, what they call constant currency growth.
Right, constant currency. So that gives investors, like those listening right now, a much clearer picture of how the underlying business is performing without all the noise of exchange rates bouncing around.
Exactly. Strips away all that complexity. And the expectation is that Alphabet will keep on this double-digit revenue growth track, fueled by that rapid expansion of Google Cloud we were talking about, and by continuing to grab more share of the digital advertising market. I mean, that market is huge.
Massive. But, it's not just about the revenue growth, right? For potential investors, there's another layer to consider. And the article points out that Alphabet might be able to grow their earnings per share even faster than their revenue. So for those of us who aren't, financial wizards, can you break down how that typically works?
Sure. That faster earnings growth is often driven by what we call margin expansion. Basically, as Google Cloud gets bigger and bigger, and as Alphabet overall focuses on becoming more efficient, there's a real good chance their profitability is going to improve.
And what does that mean in simpler terms? It means that for every dollar of revenue they bring in, a larger chunk of that dollar becomes profit.
Bingo. And that leads to earnings growing at a faster clip than the revenue itself. And for investors, that's a very positive signal.
It's like a little bonus on top of the already growing revenue. And just to add another layer of potential return for investors, the article also brings up dividends and share buybacks. It suggests that over the next decade, those kinds of actions could really juice shareholder value, even if the stock price doesn't immediately go through the roof.
Yep, those are definitely things to keep an eye on. So what we're seeing with Alphabet, at least according to our deep dive here, is that the narrative starts to shift. You move away from those immediate market jitters, and you start to see a much more compelling picture emerging, a picture of underlying strength, of long-term opportunity, would you say?
100%. So with that, let's turn our attention to our second company, Airbnb. In some ways, their core business model, at least the way it's presented in our materials, it feels a bit more straightforward than Alphabet's, wouldn't you say? I mean, it's built around this incredibly disruptive home sharing platform they've created.
Yeah, it is. It's kind of brilliant when you think about it. They basically built this huge online marketplace that connects travelers, and I'm talking about everyone listening, with people who have places to rent out. And I mean everything, from spare bedrooms to entire houses, you name it.
And it seems like this model, this whole idea of Airbnb, continues to be a major force in the travel industry and how people travel.
Oh, absolutely. Last year alone, a whopping $81.8 billion was spent through the Airbnb marketplace. That's pretty impressive, right?
That is, and that represents a 12% year-over-year growth. So the demand for this different way of traveling, of finding places to stay, it's clearly still going strong.
For sure. And their business model, that whole take rate thing where they take a percentage of each booking, well, it's directly tied to that overall spending. More bookings equal more revenue for Airbnb. Makes it pretty easy to wrap your head around as an investor, right?
Yeah, pretty straightforward. And one thing that really stood out to me, especially when you compare them to some of those younger, still figuring things out tech companies, Airbnb is already making serious money. I mean, they pulled in a net income of $2.6 billion last year.
Yep, $2.6 billion. And that translates to a profit margin of 24%, which is nothing to sneeze at. And here's the kicker. They managed to achieve that while also investing in initiatives designed to fuel future growth.
Smart. That's super smart. And speaking of that future growth, the article we dug into highlighted two main areas Airbnb is really focusing on. First, they're all about expanding their footprint, their presence in new places, new geographic markets, and they specifically mentioned Japan and South Korea. So from your perspective, why are these particular regions seen as such prime opportunities for Airbnb?
Well, it has to do with the current balance of supply and demand in those markets. Think about it. Japan and South Korea, hugely popular destinations for travelers worldwide. But compared to some more established Airbnb markets like North America or Western Europe, they've got way fewer listings.
Oh, interesting. So they see that gap, that unmet demand, as a real chance to jump in and make some moves.
Exactly. So by actively increasing the number of properties available in those places, Airbnb is doing two things. They're tapping into this potentially massive kind of underserved pool of users, people looking for those unique Airbnb experiences. But they're also, and this is key, strengthening their competitive edge on a global scale. Because think about it, when you've got more options, more places to choose from, that attracts more travelers. And more travelers attract more hosts. It creates this powerful network effect, which ultimately benefits Airbnb in the long run.
It's a win-win for everyone involved, right? More choices for travelers and more opportunities for hosts. And it brings us to their second big growth driver, new product lines. And the buzz is that we might see some big announcements in 2025.
Oh yeah, they've got some things cooking. And while the specifics are still under wraps, the basic idea is that these new products and services are going to encourage both hosts and travelers to, really dive in, engage more deeply with the whole Airbnb ecosystem, and of course, spend more.
Yeah, get more value out of it.
Exactly. So we might see new kinds of travel experiences, stuff that goes beyond just renting a place to stay. We might see enhanced services, added features, things that make the whole experience better for both sides, both hosts and travelers. The article makes a great point. Keep your eyes peeled for those announcements in 2025. They could be real game changers, real catalysts for Airbnb's growth.
Definitely something to watch. So let's talk about how the market is valuing Airbnb right now. The article mentions their market cap, which sits at about $67 billion. But then it points out that Airbnb has a lot of cash on hand, a strong net cash position, which actually brings their enterprise value down to below $60 billion. Now, for those of us who aren't financial experts, can you break down why that distinction, that difference in valuation matters?
Sure. Enterprise value gives investors a more complete picture of a company's true worth. It takes into account not just the market capitalization, which is basically the value of all their outstanding shares, but also their debt and cash holdings. And in Airbnb's case, their hefty cash reserves, they essentially reduce the net cost of buying the whole business. So for investors, that enterprise value becomes a really insightful metric to look at, to really understand what's going on.
It's like getting a discount, in a way, because of that cash they have on hand.
It's a good way to think about it, yeah. And the article also highlights that even while they're investing in all these growth initiatives we've been talking about, they're already pulling in some serious profits. Their net income is sitting at $2.4 billion, which points to a pretty solid financial foundation, wouldn't you say?
Yeah, it does. And that should give investors some confidence about their ability to keep expanding.
Absolutely. And looking ahead, the experts are predicting both strong revenue growth and a fatter profit margin, potentially hitting 30% in the long term.
And just to really drive that point home, the article lays out a potential scenario for us. It says, imagine Airbnb's revenue grows to $20 billion. Right now, it's at $11.2 billion, so we're talking about some serious growth. But if they hit that $20 billion mark and they achieve that 30% profit margin, well, their net income could skyrocket to $6 billion. And when you compare that potential future earning power to their current enterprise value,
you get an earnings ratio of less than 10. And that, my friend, could signal a significantly undervalued stock.
Music to an investor's ears. So let's do a quick recap just to tie it all together for our listeners. With Alphabet, the investment thesis, the core argument, it rests on a few key pillars. Their enduring dominance across those essential tech sectors, the vast opportunities AI is opening up, their current valuation, which seems pretty attractive, and that potential for sustained double-digit growth for years to come.
Yep. Alphabet is a powerhouse, that's for sure.
It is. And then with Airbnb, the thesis revolves around their disruptive business model, a model that's still got plenty of room to grow, especially through moving into new geographic markets and rolling out new products. They're already profitable, and as they scale, they've got the potential for some really significant earnings growth.
Exactly. And it all circles back to that market correction we started talking about. While it's perfectly natural for investors to feel a little uneasy when the market takes a dip, it's crucial to remember that these periods of volatility, they can create some really valuable opportunities to get in on high-quality companies with strong fundamentals at prices that might not have been available just a little while ago.
It's all about playing the long game, looking past the immediate turbulence and focusing on the intrinsic value, that long-term growth potential. And, it really gets you thinking, doesn't it?
About what?
About how these big shifts we're seeing in technology, in global travel, how they might continue to shape the trajectory of companies like Alphabet and Airbnb. And it makes you wonder, what other sectors might be out there right now in this volatile market offering up similar buy-the-dip opportunities?
It's a great question, a question for all of us to ponder as we navigate these interesting, ever-changing times.
Couldn't have said it better myself.